Welcome to Finance Story. And today we're uncovering some unconventional investing secrets that could transform how you approach the Indian stock market. Some of the world's most successful investors don't follow the usual rules of dividing their money into strict categories like stocks, bonds, or cash. They hunt for the best opportunities, whether it's a stock like Reliance Industries or a tech company like Zomato. In this video, we'll dive deep into why traditional strategies might be holding you back, the challenges of today's market, how to invest ethically, and why you should stay optimistic despite short-term fears. Let's explore these game-changing ideas and help you make smarter investment decisions. Let's kick things off with a big idea. Don't let rigid categories control your investments. Traditional asset allocation says, put 60% in stocks, 30% in bonds, and 10% in cash. But what if the best opportunities don't fit those boxes? Imagine Zomato's stock dips after a market correction, making it a steal, or Asian Paints offers incredible value due to a new product launch. Why limit yourself? Successful investors focus on finding value, no matter the category. This might mean you end up with an unusual mix. Maybe one year you have a lot in tech stocks like Infosys, and the next you're heavy in consumer goods like Titan, simply because they're the best deals at the time. It's all about chasing opportunities, not sticking to a preset plan. And this flexibility can lead to bigger gains in the long run. Now let's talk about the market we're in today. It's not an easy place to find great deals. Valuations are high across almost every asset class, whether it's stocks, bonds, or real estate. Companies like Bajaj Finance or HDFC Bank are trading at prices that are steep compared to historical standards. Why? There's a flood of money out there. Hedge funds and private equity firms are everywhere, driving up prices. They're bidding on businesses, often buying just to resell quickly for a profit. For example, a private equity firm might buy a mid-sized tech company, only to sell it to another fund a year later at a higher price. This frenzy makes it tough for value-focused investors to compete, as good businesses are getting pricier, and there's little room for bargains. Just a few years ago, you might have found plenty of deals. But now, the market feels like a different world where opportunities are harder to come by. Here's where ethics in investing really matter. And it's a lesson we can all learn from. Some investors handle high valuations the right way. They don't chase bad deals just to keep the money flowing. Instead, they return funds to clients when opportunities aren't there. Imagine a fund manager who sees no good deals in the market, no undervalued stocks like Titan or promising IPOs, and decides to give the money back rather than investing in overpriced assets. That's integrity, and it's how ethical investors behave. On the flip side, some managers feel pressure to spend. They might earn a 2% fee regardless of performance, so they rush into deals without fully understanding the business, like buying a company they're unfamiliar with just to avoid returning funds. That's a risky move. And it's not how you want your money managed. Look for investors who prioritize your interests over their fees. Another key idea is to invest like it's your own money, because that changes everything. Some fund managers have a big advantage. They earn fees and a share of profits, but they don't bear the losses. If they make a bad call on a stock like Vodafone Idea, they still get paid, while you take the hit. But when you're investing your own money, like most of us are, you feel every loss. That's why you should focus on understanding a company's ethical strength, not just its financials. For example, if you're looking at HDFC Bank, you might feel more comfortable investing if you trust its leadership to act responsibly, even if you're not a finance expert. This mindset pushes you to prioritize quality over quick wins, especially in a competitive market where you're up against funds that don't face the same downside risks you do. Let's dig deeper into the competition in today's market. It's fierce. Over the past 5 years, there's been a massive increase in money-chasing deals, and buyers are willing to pay high prices for even average businesses. Companies like Reliance Industries or Infosys, which might have been undervalued a few years ago, are now being auctioned off at premium prices. Hedge funds and private equity firms are even selling businesses to each other, buying today to resell tomorrow. This short-term flipping makes it hard for investors who want to hold quality businesses for the long haul. Some companies, though, prefer not to deal with these funds. They'd rather sell to investors who share their values, like those focused on building lasting partnerships rather than quick profits. But right now, those opportunities are rare, and you might need to wait for the market to cool down to find them. Despite these challenges, don't let short-term fears stop you from investing. Some worry about a bear market. Rising interest rates, global tensions, or economic slowdowns could be around the corner. But here's the thing. Opportunities often come when the market gets cheaper. If stocks like Asian Paints or Titan drop to attractive prices during a dip, that's your chance to buy. Investors who try to time the market often miss out. They might sit on the sidelines, waiting for things to get even cheaper, and miss great businesses in the process. Over the long term, India's economy is a success story. Since 1990, it's grown into a global powerhouse, and today it's a major player in the world's GDP. Your children and grandchildren will likely live better than you do, thanks to this growth. So don't bet against India. Focus on finding great businesses at good prices, no matter the macro outlook. Here's a simple analogy to tie it all together. Investing is like buying groceries. If you're going to need groceries next week, next month, and next year, would you rather prices go up or down? Obviously, you'd prefer them to be low because you're a buyer. The same goes for stocks. If you're investing for the long term, you'll do better when prices are low. You don't need to predict the market to succeed. Some investors knew stocks were a steal in the mid-70s, and they saw markets go crazy in the late 90s. But they didn't try to forecast every up and down. They just bought when they found good value, whether it was stocks, bonds, or businesses. For example, if Bajaj Finance is trading at a fair price after a market correction, that's your moment to act, not when everyone's rushing in and driving prices up. Let's wrap up with what this means for you in 2025. Break free from traditional asset allocation. Hunt for opportunities like undervalued stocks or unique deals, whether it's in tech, consumer goods, or banking. Be aware of today's high valuations and the competition from big funds. But look for ethical managers who put your interests first, returning money when deals aren't good. Invest like it's your own money, focusing on companies you trust, like HDFC Bank or Titan. And don't let short-term fears stop you from buying great businesses at the right price. India's economic future is bright, so stay focused on value, not market predictions. What do you think of this approach? Comment below, like and subscribe for more finance story updates on the Indian stock market.